Welcome! Today, we're diving into a topic that's crucial for freelancers, small business owners, and anyone who works for themselves: how self-employment income affects your Social Security benefits. Many people wonder if being your own boss changes the way you earn credits or impacts your future retirement payments. In this video, we'll break down the essentials, explain the rules, and help you understand what you need to do to maximize your benefits. Whether you're just starting out or have been self-employed for years, this guide will give you the clarity you need. Let's get started by understanding what counts as self-employment income. Self-employment income is any money you earn from working for yourself, whether you're running a business, freelancing, or providing services. This includes profits from your business after expenses, not just your gross receipts. It's important to understand this distinction because only your net earnings are considered when calculating Social Security contributions. If you're a sole proprietor, partner, or independent contractor, your income is reported differently than traditional employees. Let's look at how this income is reported and why it matters for your Social Security record. Unlike employees who receive a W-2, self-employed individuals report their income using tax forms like Schedule C or Schedule SE. These forms help the IRS and Social Security Administration track your earnings and ensure you're credited properly. It's your responsibility to keep accurate records of your income and expenses, as mistakes can affect your future benefits. Proper reporting ensures that every dollar you earn counts toward your Social Security credits. Next, let's see how these credits work and why they're so important. Social Security credits are the building blocks for your future benefits. In 2024, you earn one credit for every $1,640 in net self-employment income, up to 4 credits per year. These credits accumulate over your working life and determine your eligibility for retirement, disability, and survivor benefits. If you don't report enough income, you may not earn the maximum credits each year, which could impact your benefits later. Let's explore how self-employment taxes play a role in this process. Self-employed individuals pay both the employer and employee portions of Social Security and Medicare taxes, known as self-employment tax. This tax rate is currently 15.3%, with 12.4% going to Social Security and 2.9% to Medicare. Paying this tax is crucial because it funds your Social Security credits and future benefits. Unlike employees, you don't have an employer withholding these taxes, so you must calculate and pay them yourself, usually through quarterly estimated payments. Next, let's see how these taxes affect your benefit calculations. The amount you receive from Social Security in retirement is based on your highest 35 years of earnings, including self-employment income. The more you earn and report, the higher your potential benefit. If you have years with low or no income, those years count as zeros, which can lower your average and reduce your monthly payment. That's why it's important to report all your income accurately and pay self-employment taxes. Let's look at an example to see how this works in practice. Imagine you've been self-employed for 35 years, consistently reporting $50,000 in net income each year. Social Security uses a formula to calculate your average indexed monthly earnings, which then determines your benefit. If you underreport or miss years, your average drops, and so does your benefit. This example shows how staying diligent with your income reporting can make a significant difference in your retirement income. Next, let's discuss what happens if you continue working while receiving benefits. If you start receiving Social Security before your full retirement age and continue working, your benefits may be temporarily reduced if your earnings exceed certain limits. For self-employed individuals, Social Security looks at your net earnings and the amount of time you spend working in your business. If you earn above the annual limit, a portion of your benefits may be withheld, but once you reach full retirement age, there's no penalty, and your benefit is recalculated to give you credit for withheld amounts. The annual earnings test determines how much you can earn while receiving Social Security before your benefits are reduced. In 2024, the limit is $21,240. For every $2 you earn above this limit, $1 is withheld from your benefits. The rules are slightly different in the year you reach full retirement age, with a higher limit and a less severe reduction. After you reach full retirement age, you can earn any amount without affecting your benefits. Let's clarify how self-employment income is counted for this test. For the earnings test, Social Security counts your net self-employment income, but also considers how much time you spend working in your business. If you work more than 45 hours a month in a business you own, Social Security may consider you as fully employed, regardless of income. This is to prevent people from underreporting income while still working full-time. It's important to keep detailed records of both your income and your work hours to avoid issues with your benefits. Since self-employed individuals don't have taxes withheld from their paychecks, they must pay estimated taxes quarterly. This includes both income tax and self-employment tax. Failing to pay enough throughout the year can result in penalties and interest, as well as gaps in your Social Security record. Using tools like the IRS's online calculators or consulting with a tax professional can help you stay on track and ensure your Social Security contributions are up to date. One advantage of self-employment is the ability to deduct business expenses before calculating your net income. This can lower your taxable income and reduce your self-employment tax. However, it also means that if you deduct too much, your reported income and thus your Social Security credits may be lower. It's a balance between minimizing taxes now and maximizing future benefits. Let's review some common deductible expenses and how they impact your Social Security record. Typical deductible business expenses include office supplies, travel, marketing, and a portion of your home if you use it for business. These deductions help reduce your taxable income, but remember, only your net earnings count towards Social Security. If you claim large deductions, your reported income may fall below the threshold needed to earn credits. Always keep receipts and detailed records to support your deductions in case of an audit and to ensure your Social Security record is accurate. If your net self-employment income is low due to high expenses or inconsistent work, you may not earn enough to receive all 4 Social Security credits in a year. This can affect your eligibility for benefits and reduce your future payments. It's important to plan your business finances so you consistently report enough income to maximize your credits. If you have multiple sources of income, make sure all are properly reported to the IRS and Social Security Administration. If you run more than one business or have both self-employment and traditional employment, all your earnings are combined for Social Security purposes. This can help you reach the maximum credits each year and potentially increase your future benefit. Be sure to report all income accurately, regardless of the source, and pay the appropriate taxes. Keeping organized records for each business or job is essential for accurate reporting and maximizing your benefits. If you're a partner in a business, your share of the partnership's net earnings is considered self-employment income. You'll need to report this income on your tax return and pay self-employment tax. Partnerships can be complex, so it's important to understand how your share is calculated and ensure you're paying the correct amount of tax. This income counts toward your Social Security credits and future benefits, just like income from a sole proprietorship. If you operate your business as a corporation, your income may be treated differently. Wages you pay yourself as an employee are subject to regular payroll taxes, while dividends or distributions are not. Only wages count towards Social Security credits, so it's important to structure your compensation appropriately. Consult with a tax professional to ensure you're maximizing your Social Security contributions while staying compliant with tax laws. With S corporations, you may receive both a salary and distributions. Only your salary, which is subject to payroll taxes, counts towards Social Security. Distributions are not taxed for Social Security purposes. It's important to pay yourself a reasonable salary to ensure you're earning credits and building your future benefit. Underpaying yourself to avoid taxes can hurt your retirement income in the long run. Limited liability companies, LLCs, can be taxed as sole proprietorships, partnerships, or corporations. If you're a single-member LLC, your income is treated as self-employment income and subject to self-employment tax. Multi-member LLCs are usually treated as partnerships, with each member reporting their share of income. If the LLC elects to be taxed as a corporation, only wages count towards Social Security. Understanding your LLC's tax status is crucial for proper reporting and maximizing your benefits. If you employ family members in your business, their wages may also be subject to Social Security taxes, depending on their relationship and age. For example, payments to your spouse or children under 18 may be treated differently. It's important to follow IRS rules to ensure everyone's earnings are properly credited for Social Security. This can help your family members build their own benefit records for the future. Farmers and agricultural workers who are self-employed must also report their net earnings and pay self-employment tax. Special rules may apply for certain types of agricultural income, but the basic principles remain the same. Report all income, deduct legitimate expenses, and pay self-employment tax to earn Social Security credits. Keeping detailed records is especially important in agriculture, where income and expenses can vary widely from year to year. Gig workers, such as rideshare drivers or online freelancers, are considered self-employed and must report their net earnings for Social Security purposes. Even if you receive payments through apps or platforms, you're responsible for tracking your income and paying self-employment tax. Many gig workers overlook this requirement, which can lead to missed credits and lower future benefits. Make sure to keep records of all your gigs and report your income accurately. Self-employed individuals can qualify for Social Security Disability Insurance, SSDI, if they have enough credits and meet the medical requirements. Your eligibility and benefit amount depend on your reported net earnings over time. If you become disabled and can't work, your Social Security record will determine your SSDI payments. This highlights the importance of consistently reporting your income and paying self-employment taxes throughout your career. If you pass away, your family may be eligible for survivor benefits based on your Social Security record. The amount and eligibility depend on the credits you've earned through self-employment income. Ensuring you report all your income and pay self-employment taxes helps protect your family's financial future. Survivor benefits can provide vital support for spouses, children, or dependent parents after your death. The age at which you start receiving Social Security affects your monthly benefit. If you claim benefits before your full retirement age, your payments will be reduced. Waiting until full retirement age, or even later, increases your monthly benefit. This is true for both employees and the self-employed. Planning when to claim benefits is an important part of your overall retirement strategy. If you delay claiming Social Security past your full retirement age, your benefit increases by a certain percentage each year until age 70. For self-employed individuals, this can be a smart way to maximize your retirement income, especially if you continue working and earning credits. Delaying benefits is a personal decision that depends on your health, finances, and retirement goals. You can check your Social Security record and estimated benefits by creating an account at ssa.gov. Reviewing your statement regularly helps ensure your self-employment income is reported correctly and that you're earning the credits you deserve. If you spot errors, contact the Social Security Administration to correct them as soon as possible. Staying proactive protects your future benefits. Mistakes in reporting your self-employment income can lead to missing credits or lower benefits. If you notice an error on your Social Security statement, gather your tax records and contact the Social Security Administration to request a correction. The sooner you address errors, the easier they are to fix. Keeping organized records of your income and tax filings is the best way to avoid problems down the road. As a self-employed individual, planning for retirement involves more than just Social Security. You may want to contribute to retirement accounts like IRAs or SEP IRAs to supplement your future income. Social Security provides a foundation, but additional savings can help you maintain your lifestyle in retirement. Start planning early and review your strategy regularly to stay on track. Navigating self-employment taxes and Social Security rules can be complex. Consulting with a tax advisor or financial planner can help you make informed decisions, avoid costly mistakes, and maximize your benefits. Professional advice is especially valuable if your business structure or income varies from year to year. Don't hesitate to seek help when needed. Social Security rules and tax laws can change over time. It's important to stay informed about updates that may affect your self-employment, income, and benefits. Subscribe to updates from the IRS and Social Security Administration, or check their websites regularly. Being proactive ensures you're always following the latest rules and maximizing your benefits. Paying self-employment tax also contributes to your Medicare coverage. When you reach age 65, you'll be eligible for Medicare if you've paid enough into the system through your self-employment taxes. This is an important benefit that helps cover healthcare costs in retirement. Make sure you're paying the correct amount of tax to secure both Social Security and Medicare benefits. If you're married, your spouse may be eligible for Social Security benefits based on your record, even if they haven't worked or have lower earnings. This includes self-employment income you've reported over the years. Spousal benefits can provide additional financial support in retirement, so it's important to understand how your earnings affect your family's future. If you're divorced, you may still be eligible for Social Security benefits based on your ex-spouse's record if the marriage lasted at least 10 years. This applies whether your ex was self-employed or an employee. Understanding these rules can help you plan for your financial future after divorce and ensure you receive the benefits you're entitled to. If your ex-spouse passes away, you may be eligible for survivor benefits based on their Social Security record, even if they were self-employed. The rules are similar to those for married couples, with some additional requirements. Survivor benefits can provide important financial support, so it's worth understanding your rights and how self-employment income factors in. Non-U.S. citizens who are self-employed in the United States may be eligible for Social Security benefits if they pay self-employment tax and earn enough credits. Special rules apply for international workers and those with work visas. It's important to understand your status and ensure you're meeting all requirements to qualify for future benefits. If you're a U.S. citizen living and working abroad, you may still be required to pay self-employment tax and can earn Social Security credits. The U.S. has agreements with some countries to avoid double taxation and ensure your work counts toward your benefits. Check the rules for your country of residence and keep up with your U.S. tax filings to protect your Social Security record. Some self-employed individuals may also qualify for state or local government pensions. In certain cases, receiving a government pension can affect your Social Security benefits through the Windfall Elimination Provision, WEP, or Government Pension Offset, GPO. It's important to understand how these rules interact and plan accordingly to avoid surprises in retirement. Some self-employed people choose to retire early, but claiming Social Security before full retirement age means a permanent reduction in monthly benefits. It's important to weigh the pros and cons of early retirement, considering your health, finances, and other sources of income. Careful planning can help you make the best decision for your situation. Many self-employed individuals continue working after claiming Social Security. While your benefits may be temporarily reduced if you earn above the annual limit, continuing to work can increase your future payments. Each year you have higher earnings, your benefit is recalculated, potentially raising your monthly payment. This can be a smart strategy for those who want to stay active and boost their retirement income. Depending on your total income, a portion of your Social Security benefits may be taxable in retirement. This includes income from self-employment, investments, and other sources. Understanding how your income affects your tax liability can help you plan withdrawals and manage your finances more effectively in retirement. Good record keeping is essential for self-employed individuals. Keep copies of your tax returns, receipts, and business records for at least 7 years. Accurate records help you verify your income, support your deductions, and resolve any disputes with the IRS or Social Security Administration. Organized documentation is your best defense against errors and audits. Social Security is a vital program, but it faces financial challenges in the coming decades. Lawmakers may make changes to taxes, benefits, or eligibility rules. As a self-employed individual, it's important to stay informed and flexible in your retirement planning. Diversifying your income sources and saving independently can help you prepare for any future changes. To sum up, self-employment income plays a crucial role in your Social Security benefits. Accurate reporting, paying self-employment tax, and understanding the rules are essential for maximizing your credits and future payments. Stay organized, seek professional advice when needed, and plan ahead for retirement. By taking these steps, you can ensure a more secure financial future for yourself and your family. Thank you for joining us on this journey through self-employment income and Social Security benefits. Remember, being proactive and informed is the best way to protect your retirement. If you have questions about your specific situation, consider reaching out to a financial professional. Wishing you success and security as you build your future.